A company grew its revenue just 4.4% last year. Its shares have quadrupled off their low and now trade near 57 times earnings, against an industry average closer to 24. One famous investor is shorting it. The chief executive is selling. Something has to give. Which is it then? Is Applied Materials a modest cyclical dressed up as an artificial intelligence compounder? Or is a genuine supercycle about to justify the price? By the end, you will have a clear answer, grounded in the numbers. Here is what this breakdown delivers. How Applied actually earns its money, what its margins and returns reveal, how management hands cash back to owners, where the shares sit against fair value, and the single risk that could unravel the whole story. Applied Materials builds the machines that turn bare silicon wafers into finished chips. Deposition, etching, ion implantation, inspection. Almost every advanced processor and memory die inside an artificial intelligence server passes through its tools. No rival spans more of those process steps. The money splits into two engines. Semiconductor systems, the equipment sold to chipmakers, generated $20.8 billion in fiscal 2025, 73% of the total. Applied Global Services added $6.4 billion, the recurring service and spare parts business that follows every installed tool. Those two engines behave very differently. Systems revenue is lumpy, rising and falling with customers' capital spending decisions. Services is the ballast, contracts, and parts that compound quietly as the installed base grows. At 23% of sales, though, it is not yet big enough to smooth a real downturn. The growth record is where the valuation starts to strain. Revenue climbed from $23.1 billion in fiscal 2021 to $29 billion on a trailing basis, a compound rate of about 5.3%. Respectable for an industrial cyclical, hardly hypergrowth. Earnings per share did better. Diluted earnings rose from $6.40 in fiscal 2021 to $8.66 in fiscal 2025, compounding near 8% a year. The gap over revenue came from richer margins and a steadily shrinking share count. The margin story is the strongest pillar of the bull case. Gross margin widened from 47.3% in fiscal 2021 to 49% on a trailing basis, and the latest quarter touched 50%, the best in more than a quarter century. Yet, operating margin has barely budged, stuck near 29% for 5 straight years. Why? Applied pours the gross margin gains straight back into research and development, now 13% of revenue. A deliberate bet to hold its technology led through each node transition. One number complicates the whole narrative. Return on invested capital ran at 30.6% in fiscal 2021 and peaked above 34%. It has since slid to 21.6%. Still excellent, but the direction is unmistakably down as the capital base swells. The balance sheet, though, is a fortress, exactly what a cyclical wants heading into any storm. Total debt is almost perfectly offset by cash, leaving the company effectively net cash. Interest coverage exceeds 30 times operating earnings. It can fund everything through a trough untouched. Cash generation is solid but softening. Free cash flow was $5.7 billion in fiscal 2025, about $6 billion on a trailing basis. The wrinkle is capital expenditure, which tripled to over $2 billion, lifting spending toward 8% of revenue and trimming cash conversion. Management returns cash aggressively. Across fiscal 2021 through 2025, Applied repurchased roughly $21 billion of stock, and the effect is real. Diluted shares fell about 12%, from 919 million to around 802 million. That shrinkage lifts every per-share number. The dividend is small but fast-growing. The payout per share climbed from 92 cents in fiscal 2021 to $1.91 on a trailing basis, compounding in the mid-teens. It eats just 13% of earnings, safe enough to double. This is a total return story, not an income one. Why do these returns stay so high? Two barriers: decades of process know-how across deposition, etch and inspection, funded by that heavy research budget. And switching costs. Once a tool is qualified into a production line, ripping it out is enormously costly. That is what makes the services stream so sticky. But the moat is not absolute. Applied does not own the industry's most protected niche. That belongs to ASML and its lithography monopoly. In etch and deposition, it fights hard against Lam Research and Tokyo Electron. And those slipping returns argue the moat is holding, not widening. Still ahead, where fair value actually lands, and the one risk that could break the case. First, the backdrop. A high beta, high multiple stock like this is acutely sensitive to interest rates. With rates still elevated, there is little cushion if the growth story stumbles. The sector cycle is the real crux. Wafer fab equipment is one of technology's most cyclical corners, and the industry is arguably late in a powerful artificial intelligence upleg. Samsung recently posted record profit on surging memory prices, yet its shares fell as investors questioned how long that pace can last. The share price tells the whole Whiplash story. It has surged nearly 300% off its 52-week low, yet still sits about 14% below its high after a sharp sell-off. Sentiment here is euphoric and fragile. The catalysts are concrete. Applied's latest quarter delivered record revenue of $7.9 billion, up 11%, with that quarter-century best margin. Management targets advanced packaging revenue growing more than 50%, and high-bandwidth memory tools doubling from $1.5 billion toward $3 billion. Against that sit two loud warnings. Michael Burry disclosed a short near $729, framing the rally as a bubble. And Chief Executive Gary Dickerson sold roughly $105 million of stock in June, some above $700, with no confirmed trading plan behind it. What is it worth? Discounted cash flow is the anchor, growing free cash flow from about $7 billion toward $13 to $14 billion by 2029, with a 4% terminal rate and a 10% discount rate, produces a value near $330 to $450 a share. The earnings lens says the same. At today's price, the shares fetch about 50 times fiscal 2026 earnings and 37 times fiscal 2027, a steep premium to the equipment industry's 24. Apply a still generous multiple to forward earnings, and the range lands around $340 to $480. Does the street underwrite the acceleration? Consensus sees revenue reaching $33.4 billion in fiscal 2026, then $42.5 billion in 2027, growth of about 18 and 28%. Earnings per share of $12.24, then $16.60. Strong, but not the 30% the story sometimes claims. The most conservative lens is enterprise value to EBITDA. The shares trade near 44 times trailing EBITDA, against a through-cycle range of 10 to 19. Normalize onto forward earnings power at a generous multiple, and the implied value is roughly $300 to $400. Blend the three: discounted cash flow, forward earnings, and enterprise value to EBITDA, and fair value lands around $360 to $470. Against a price near $616, the stock sits roughly 24 to 42% above fair value. Expensive on every construction. What would break this? The dominant risk is that the acceleration simply arrives late. At 50 times forward earnings, the punishment for a miss is brutal. It would show first in bookings, then in the system's revenue line, and one big customer's pause can swing a quarter by hundreds of millions. The slower danger is returns colliding with spending. If return on invested capital keeps drifting below 20% while capital expenditure stays near 8% of revenue, the business is quietly getting more capital hungry and less efficient, and a premium multiple becomes far harder to defend. Here is the answer to the opening question. Applied Materials is an outstanding business at an expensive price. The moat is wide, the balance sheet a fortress, the margins genuine, but a company that grew 4.4% last year is priced for a large, durable supercycle. The quality is not in doubt. The price paid for it is. The single biggest risk to that caution is that the artificial intelligence cycle proves early rather than late, and the shares grow into their multiple faster than any cash flow model can credit. This is an educational analysis, not investment advice. Every figure comes from public filings and consensus estimates that can change. Weigh your own circumstances before making any decision. If this sharpened how you see the stock, subscribe. It genuinely helps. And drop a comment with the company you want analysed next. Thank you very much for watching, and we'll see you next time.